Hello, this is Corner Invest. Today I'll be talking about the market dip so far. So in the past 2 to 3 days or so, the market has been down around like 4 to 5% already, and the Nasdaq is down maybe around 5% or so. And then you have all your Max 7 companies down in a correction territory. You have Amazon down 15%, Google down 15% as well. You have I think Meta down 10 plus percent from its highs as well. So is it time for you to buy the dip on all these companies? So I think out of all these companies over here, the most compelling company for you to buy is Google. Google is trading at a 22 PE. All these other companies are trading at a 30 plus PE. So you see the disparity over there. And you have Google as well, the YouTube business. YouTube is extremely undervalued. No one is valuing Google's YouTube. I don't understand that portion. But anyways, back to the topic. Is it time to buy the dip on all these Max 7 companies? So for me, I bought some shares, meaning I bought a bit of Google as well in the past few days as it came down and down and down. I think it's an okay time for you to buy the dip right now, but don't expect it to rebound so quickly. The markets are extremely overvalued. We're now currently trading at around a 27 trailing 12-month PE for the S&P 500. That is extremely high in terms of historical averages. Most of these companies, you have Nvidia at a 55 PE, you have Amazon at a 36, Microsoft at a 32, Meta at a 28. All these are extremely high PEs as compared to historical averages. And yes, maybe the top isn't there yet because the markets don't normally top in fear. The markets normally top in euphoria. But maybe the top is not in yet, but I don't think it is time for you to go in 100% into equities. Save some cash, especially in a time like this where everything is overvalued. As for the companies on my watch list right now, I have Google. I want to add more Google. I have ASML as well. Hopefully it dips a bit more after Nvidia's earnings. And then I have some other Max 7 companies which I would like to have some exposure to as well. So Meta, Microsoft, and Amazon as well. Okay, so a company that I've looked into as well, I've been looking into this company, is MSCI. So MSCI is the company that licenses out all their indices. So you have your MSCI Global Index, you have your MSCI Emerging Markets Index, then you have your MSCI Asian and MSCI Tech and all that. So what this company does is it doesn't manage the assets. What it does is it just collects a pool of different companies and then they license out their brand name to all these asset managers and then they collect a fee from them. So it's sort of like a franchise or royalty business. And so they have no credit risk, meaning to say they have no risk to the assets under management. So if the asset under management drops, maybe their earnings will drop by a bit, but it is not that they will lose earnings and all that. So for MSCI, if you look back in 2020, 2022, 2018, the revenues in those years, although they didn't grow as fast, they still managed to grow. So I love companies like this where their fundamentals are able to grow even when the market crashes. So MSCI is a company that I believe can go around 12 to 13% to maybe like 10, 20 years down the road. So this company over here is a compelling opportunity right now, I feel. But the problem with this business is it is always trading at a very high valuation. So price and meaning valuation and business quality always come hand in hand. So when you have a quality business like MSCI, it has always traded at a premium relative to the markets. So if you look at the historical PE, it has never traded below a 35 PE. So I think this company over here, the only risk associated with it is because of the valuation. I think this company is a high quality compounder, and an investor that I look up to is Dev Kantasarya, and he recently bought into this company as well as I was researching it. He bought it at a much higher price. He bought it at around $600 to $615 a share. So if you're buying in now, you're actually buying in at a lower cost basis compared to him. So for me, I think MSCI is an amazing business. I would like to own a share in it, meaning to say I want to buy the stock. But now the valuation is a bit high. Maybe now it will be around fair value or so. So I'm waiting for a dip in the share price so that I can buy a bit of it. The next stock that I've been looking at is United Health. So for United Health, the problem with the business is they will harm meaning they make money from harming their consumers. Not really harming their consumers, but they make money at the expense of the consumers. So the problem with this kind of business models, right, is whenever there's an event like what they had when the CEO died, then suddenly there will be an uproar and then there will be a social event and all that, and then this company could take a hit for maybe a year or two. But if you clear out all that noise, you just look at the valuation of this company is extremely cheap now as compared to its historical averages, and it is I would say it's a quality compounder, not high quality in the sense that it has a monopoly and all that, but it has had stable earnings for the past 10 years or so if you look back since Obama Health. So if you can block out all that noise and just ignore it and just buy into the company right now, I think this is a buying opportunity for United Health. The last stock that I've been looking at is Ulta Beauty. So I actually have quite a big stake in Ulta Beauty already, and I only have one more entry point, which is around $320 a share. So for Ulta Beauty, the story is extremely easy for this one. It is currently trading at a 14 PE. It has a 20+% ROIC, meaning to say it is able to reinvest its earnings and grow earnings at a very fast rate. And it was one of the companies that Warren Buffett actually bought into, but then he sold it 1 quarter later, maybe because he couldn't handle the new management and all that. But for Ulta Beauty, the thesis is extremely easy. It is just they grow a bit above inflation and then they just buy back a ton of share using their free cash flow, which is what they've been doing for the past few years or so. But the risk is always there with all these retail businesses. So for retail, you'll normally be more susceptible to all your economic downturns and all that. So be careful with this one, because if we go into a recession, this company will definitely fall at least 30-40%. But if we can stay in this economic environment for the next few years or so, they can just do their thing and do their buybacks and all that. This could easily be a 15% CAGR for the next 5 years.